So you want to go down the journey of Airbnb investing and you don't have much money or much time. Well, what if I told you you could get 5 rentals in 5 years following these simple steps? Let's talk about it on today's episode. Running short-term rentals is constant work. Guest in, guest out, and you're still expected to be your own bookkeeper? I had multiple listings going and no real way to manage the money that was coming in. Between flipping beds and trying to match receipts from a payment a month ago, I couldn't even know if I was making real money. That's when I found BaseLane. It's the official banking platform of BiggerPockets, and it handles all of the tracking and reporting I used to do manually. Now I can see real-time financial reports for each listing and know if there's a problem that's arising. For example, last month I had a 300% spike in my electric at one of my properties, and I realized that I needed to do something. I quickly set up a smart thermostat inside of it, and my electricity bill was cut almost in half. Thanks to things like BaseLane, I avoided losing my profits and actually getting them back in my pocket. Start protecting your profits today by signing up at baselane.com/BP, and you'll get your $100 bonus right when you sign up. Hey everyone, my name is Garrett Brown. I'm the BiggerPockets short-term rental resident expert and a short-term rental investor myself from Houston, Texas. I have a portfolio that grossed over $1 million last year, and I'm here to teach you exactly how I scaled from 0 units to 5 within a couple years. Or to be exact for this video, 5 rentals in 5 years. Now this is not 5 in 5 days or 5 by next Tuesday. This is a real plan to get 5 in 5 years. So if you like this type of content, please hit subscribe below and let us know in the comments so that we know that this is something you want to see us do more of. Otherwise, I'm just blindly making videos guessing on what you actually want to watch. So let's get into exactly how this would work. And there's a little twist to it because guess what? You don't have to buy a property every year to get a new one. We're going to cover low money down rentals for your first one, how co-hosting can make your business scale even quicker, why DSCR loans are a cheat code for short-term rental investors, and how to turn all this into a profitable Airbnb portfolio. So without further ado, let's get into it and start with year 1. So this first year is just about getting the ball rolling. The snowball method is very important in real estate, and pretty much every time you can't get to that big goal you have unless you just start. You can have analysis paralysis all day, but sometimes you just need to learn by fire and get into a deal after you've done research for a few months. These are 4 different quick options that you could use for that first deal. You could house hack into your first deal. If you're able to live in a unit, say a duplex you get with a 3.5% down FHA loan or 3 to 5% down owner occupied conventional loan, find a duplex in an area that has a decent short-term rental demand. Vacation rental markets are even better, but if you don't live exactly near one, figure out where you can do short-term rentals at compared to, with the regulations, and see if your city would actually make for a good short-term rental duplex in this side. You can use something like AirDNA to see what type of potential revenue you could make, but live in one side, get a low owner occupied loan down, have a rental on the other side, and then you're able to manage it and learn through the whole process exactly how short-term rentals work. And this may be the start to something beautiful for you. The second option for your first year would be a vacation home loan. You can get most of these with 10 to 15% down. 10% used to be the standard, but some things have changed a little bit. There's a few stipulations into the vacation home loan rental. So talk with an investor-friendly agent to see exactly what that may be. But you have to use the property some. I can't remember the exact numbers. I think it's 14 days or more that you have to personally use the unit. But this is when you could go stay in the place, do some renovations, enjoy it for yourself, the lifestyle benefits of short-term rentals. And these loans typically have better terms than just a pure real estate investment loan. The third method would be something like rental arbitrage. It's not completely dead. People think it is the most dead method out there, but you still could possibly find a deal out there that works as a short-term rental. Maybe the person was a failed short-term rental operator and didn't want to host it and didn't want to put money into, the photos and just being a good host. There's a lot of people out there that had that. Or maybe you could find just a furnished rental of somebody that never wanted to try it, and you're able to make it a numbers game that where if you just talk to enough people, you might be able to get that first unit out of this that really can cash flow and get your business off the ground. The fourth option would be to partner up with someone. You do the work, they bring the money, split the equity 50-50, and you do all the heavy lifting mentally and physically possibly for the unit. You have to find a partner with capital, but talking to people and telling them what you're actually wanting to do and what you've been studying can help this door open up even more for you to start. My personal vote would be to figure out the house hacking method with a low owner occupied loan in a vacation area that is going to have pretty decent return on short-term rental guests coming in, or in a downtown area that allows short-term rentals. It has enough people coming in that it outweighs the hotels there, or maybe there's just not good hotel options anyways. So your mission for year one, get a unit up, get some 5-star reviews, and learn about hosting to become a better host for your second year. Now we're into year two, and this is where it starts to get interesting because I highly recommend for year two, you get a co-hosting client under you. This is another owner out there that either has a rental that's not performing well, or they're tired of managing, or somebody that has a vacation home that they've never rented out before because they've heard about these raging parties and all these things under the sun that just are not true most of the time. But this will be able to help you scale even more. You've learned so much on that first year. You shouldn't have to put any money into this deal really besides building out your business infrastructure for you. And this is really going to be the chance to open up and start to be able to get way more clients coming in with no money down, because your reputation will, precede you as you're going forward and doing these different things. You can get about 20 to 30% of the revenue from the rental coming in, depending on how experienced you are and what you work out with the host. That can easily just be almost all income coming in on top of what you're already doing. You have a few software things and a little bit more work that you have to do, but co-hosting in that second year will be the transition you need to get into year three, to where you can take that cash flow and possibly get into your next property that you own. Now for year three, we're starting to scale with leverage. Smart leverage. This is when the DSCR loan comes into play. This is a debt service coverage ratio loan. These are specific lenders out there. They do all types of loans, but some lenders will have a DSCR loan product. They'll qualify the property just based off the revenue projections from something like AirDNA or a few other forms that they use. And they don't even care about your personal income. All they'll care about personally is your personal credit score. Little higher rates typically with these, but you just don't have to do all the paperwork that goes with it, and the property will qualify just on what they're actually projecting. And now that you have some experience, it will be easier for them to take this risk with you, that you have a couple short-term rentals under your belt. You will need about 20 to 25% typically for these types of loans as a down payment. Hopefully you've been saving some of that cash flow and you're able to, roll it into a new product. If not, this is when you also could try to partner with someone that has the 20% that they could put down. You bring the experience and the hustle that you have, and you're able to much easier convince them that it's a good idea to invest with you because you have a track record now. It's a little tougher in the beginning when you haven't shown that you even can make one of these deals work. But now that you're in year three and have a little more under your belt, maybe you have a couple other co-hosting clients besides just the one that you added last year, but there's a good chance you'll be able to make it work. You might even be able to cash out refinance or take a HELOC on your first property and put it into a new property there that you know is going to cash flow and pay off that debt. Now we're rolling into year four and we're really starting to get our wheels going now. This is when everything starts to really compound. Option one is to keep reinvesting the profits. You can get another property. You could keep adding more co-hosting clients. Another option is to raise even more capital from a partner, now that you're more experienced, to do an even bigger deal. Maybe you're ready to tackle that $1 million property in that dream vacation market you were, hoping to be in. Year four is there's a ton of options coming your way, and you have that experience to really know now like what works, what doesn't work, and how to really operate your systems even better. Or in the final option, which is my cup of tea personally, is now it's time to add a really unique stay. If you didn't have anything that was profound, marketing wise before, this might be when you expand to do one of those, luxurious tree houses in a known vacation market, or maybe you buy one that wasn't performing well. This is when I would start to expand your portfolio some and really figure out like what works and what you enjoy, what markets you enjoy. The fifth year, the final year of this little 5 and 5, you know what you can do by this point now. You can have all these myriad of options. Hopefully you've been reinvesting your profits, reinvest them back into your properties to make them more profitable, maybe increase your own personal income. But this is when you could buy another DSCR loan product. Maybe you're looking to get into boutique hotels soon. Maybe that's the next step for you. I feel like Airbnbs are the gateway drug to boutique hotel investors, basically, is probably that we all want to be at some point. Maybe you take one of those co-host clients that you've been getting. Hopefully you keep adding on a few as word of mouth goes and you're networking and getting in some of these circles. But now maybe you convert one of those into into you own the unit instead. Maybe you buy them out and maybe they want to move on to something else, or they need to pay for something and do something else that with their property that they want to. Now you can keep scaling on both sides. Co-hosting is easily the best one to scale without a lot of money into it, to keep adding properties. But reinvesting back into the properties you actually own is the goal in the end, because it's not just cash flow we're looking for. We're looking for long-term appreciation and equity in these properties we're doing. Now, at this point, you probably have at least 5 units under management. You have a reliable system between your property management software, your cleaning situation, your bookkeeping, all those things like that. This will help you be even more profitable going forward to fine tune these. And as you keep expanding and go into year 6, 7, 15 down beyond, you'll have all the things set up to have a real business and a real estate investment portfolio all in one, which is what short-term rentals really are. So here's the bottom line. You don't have to own 5 properties in 5 years to make this a profitable business. You can find smart and creative ways to scale, or you can even just have one vacation rental property in an area you like to go in that pays for itself, that in the long term, you're having people pay down your debt and help your tax incentives and all these other things that are so great about real estate, that now you're probably starting to see that the road isn't as daunting as it seems like if you just take it one rental at a time for 5 years ahead. I appreciate you making it all the way to the end of the video. If you haven't checked out baselane.com/BP yet to get your $100 bonus when you sign up and fund your account, you can do that by checking the description below. They are the leading banking, bookkeeping, and accounting platform out there for real estate investors. So do yourself a favor and check out the link below. We'll see y'all in the next video. I think YouTube wants you to watch one of these ones right here.